Hi, everybody. Barry McGuire here for Barry McGuire's Creative Real Estate Education Series. It's the Monday main event. We meet up most Mondays at 5 p.m. Mountain Time to talk about all things creative real estate. And to help us out, we have experts on, insurance experts, foreclosure experts, lending experts, accountants, appraisers, developers, anybody who can help us with our quest for successful creative real estate. My wife Donna and I also do what we call focus workshops, which are 1 day or 2 day live events where we meet up in person, serve you fabulous food, and talk about a strategy or strategies, depending on whether you're in 1 day or 2 day events. We did wholesaling in Calgary. That was our first full day wholesaling event. I think that was in March. Agreements for sale in Toronto in April, which was very successful, partly because we now have quite a number of lawyers who want to learn about AFS and will support the program in Ontario. And then we did our famous Rapid Cash program here in Edmonton. That's 2 full days. That was May 27th and 28th. So we do those every once in a while. And we also have home study kits that come from recording these events, where we give you the manuals and really you can get going if you have a home study kit. So that's who we are. We're looking to support you in your creative real estate investing. And today we are delighted to have Stuart and Denise MacPherson on to help us. There they are. Welcome to the program, you guys. Thank you very much for being here.
Glad to be here.
Yeah,
Thanks so
you.
much.
It's always nice to connect with you, Barry.
Thank you, Denise. Now, folks, Stuart, Denise, and I have been hanging out for I'm thinking we're talking maybe 15, getting on 20 years now. Might not be quite that long, but met you folks when we came to Toronto, and we've had an ongoing relationship ever since. So today we are continuing on with our series on private lending, and we are looking to hear from Stuart and Denise their pearls of wisdom on private lending, because they have a focus on that area, have done a ton of it, certainly have done some coaching and are deeply involved in our registered plan lending. But Stuart and Denise, why don't you give the folks a bit of background on, who you were before you were registered plan lending gurus, and how you worked your way through to where you are now.
We can do that. Denise and I live in Ottawa, the nation's capital. And like many people who live in Ottawa, we both did careers in the federal public service. One thing that happened is we were getting closer to farther along in our career, I'll say, is we both had that life circumstance that happens to so many people in North America these days, is we each went through a divorce. Mm-hmm. And when we got together, finances were a little tight.
Divorce creates havoc with your finances. Let's be clear about that.
So even though we did have a nice pension plan with the federal government, we did have to share that with our ex-spouses, and the rest of our finances got shot. So we were looking for something that was going to assist in our retirement years and create the lifestyle that we really wanted. And we started taking a look around at various options, didn't like most of them, and happened across real estate. And I have to admit that Denise is more of the go-getter than I am. I'm more of the reluctant boat anchor. And so we actually looked at real estate back in the mid-90s. And I got panicked. And at the time, we were both still working for the federal government. And I said, listen, we're those crazy public servants that were putting in 60 and 70-hour work weeks. I said, when are we going to have time to do real estate? So we walked away from it. But in the late 2000s, around 2009, we just knew that we needed to do something, and we decided to pick it up again. So we got into real estate. Denise retired from the federal government in January of 2010.
And started investing the next day.
And basically what happened was that as we were going along, we started to learn about real estate, but we were always keeping an eye on our RRSPs. Most of our RRSPs, like most people, were invested in mutual funds. And if you remember the 2008 they took a deep hit and we lost lots of money. And we just knew that mutual funds in the stock market was not the way that we were going to protect our retirement. And that's when Denise heard someone mention the word RRSP mortgage.
It's like, boom.
And it was funny because we had no idea where she heard the word from, but she decided to do the research. We started looking into what was involved in doing a mortgage using RRSP funds.
So if I can interject, the very first real estate transaction we ever did is we took my RRSPs. I left government, and at that time, they don't anymore, but they gave you a severance pay, which is so much for every month or weeks or whatever, every year that you were with government. And I took that amount in RRSPs and I actually loaned it out. I said, I've got to find out how it works. So before we ever bought our first property, we loaned on a property. And on that one, I recall it was on a 3-year rent-to-own property that we loaned it out. And I figured that one way to learn how to do RSP mortgages was for me to be a lender so I could become a borrower. And that's how we started with the RSP mortgages right out of the gate, basically before we ever even bought our very first property.
So then we started buying properties. And as we became landlords, we all of a sudden had a realization. If we can loan on a mortgage, we could borrow against some of our income properties on a mortgage. And that's when we saw the other side of the strategy and we started figuring out how to use RSP mortgages to build our portfolio.
And to be honest, our very first property is the only property we haven't used an RSP mortgage on. The only one. So we've used them extensively since 2010.
That's a valuable tool if, you know, every property in your portfolio has an RSP mortgage involved, except one. That's I mean, I guess that's setting out the utility and value of the strategy.
And I mean, the big thing is that they don't always have a mortgage. We use our mortgages very strategically. As such, we may put a mortgage on a property in order to use the funds from that property in another project. And then when the other project comes to fruition, we pay it out.
Right. So then that always leaves yourself room to go back and borrow again for another project at another time.
Absolutely.
It's kind of like your own private piggy bank.
And this why it's unlimited. Barry, I don't know some of the latest figures that I've seen. There's more than $2.1 trillion of registered funds out there. And we're not just talking RSP. That includes TFSAs, the RIFs, the
locked-in retirement accounts.
The RRSPs, like all types of registered funds.
Yeah. That's a good thing to say, Denise, because when people talk about this sector, they always say RRSP mortgages, but it's registered plan mortgages. And there's probably at a minimum 5 different types of registered plans where if you have money in, you can lend it out.
And I mean, the nice thing is that tax-free savings accounts are a great gift from the government. The government doesn't give us many gifts, but the tax-free savings account can be a real gift.
Yes. You know, and I'm going to serve it up for you, Stuart. Now, Stuart, why is that such a great gift?
Well, the nice thing is that with the growth of the tax-free savings account, the way that works is that if you've never owned a tax-free savings account, if you've never opened one up, you never lost the capacity to put money into that up to the maximum amount that a government allows. Now, it started off at $5,000 a year that you were allowed to put in.
Back in 2009.
So in the early years, the tax-free savings account wasn't a very big account. But the government indexed it to the cost of living. And so it's now reached a point where you can put $6,500 a year. But again, that limit, if you've never used it, grows. As long as you were 18 years old in 2009, you get the capacity to put in right now $88,000.
Yeah.
So if someone had cash, but what they wanted to do, rather than investing the cash and having it as taxable income, they could put that cash into a tax-free savings account, then use the tax-free savings account for a registered plan mortgage, any interest earned by the mortgage gets paid back into the tax-free savings account. And at any time that a person wants to, they can withdraw cash from their tax-free savings account tax-free.
Yes.
And the other neat thing is, with a tax-free savings account, is if you draw the cash out, you're allowed to put the money back into your tax-free savings account in the next calendar year. So even if you've got a need right now for some cash, that doesn't take you out of the market. With an RRSP, if you take money out, you pay tax on it, and that's it.
Well, so that's the very best of both worlds, because if you're lending money not in a registered plan, if you just got cash and you're lending it to someone, and someone is paying you 10% interest, you're going to pay tax on that interest. I think interest accumulates the tax at the highest marginal rate of the taxpayer.
It does.
Mhm.
It does.
It's the worst case scenario if you're lending outside the plan, and the very best case scenario if you're inside the plan. And that, folks, that often doesn't happen. There's often gradations in between best and worst. But with the example Stuart just gave with the TFSA, it is the best to be take advantage of being able to lend in a TFSA and not get charged that huge tax on the interest that you earn. So
Exactly.
That's really good. That's really good. All right. Well, with that bit of intro, Donna says, I haven't seen her very much on here. Donna says, are the lending rules the same across the different registered plans? That's a good question.
The lending rules, you can lend, but the way it is for registered funds is CRA has various items that you can actually invest in with your registered funds. And one of the big things for real estate investors is that you can use those registered funds to invest in mortgages. And that's why it became such a great catalyst for us to grow a portfolio, is having that capacity to be able to do mortgages, whether we're lending or whether we're borrowing, because we do both sides of the fence, basically.
Sure.
We do both. So that allows us to do that.
Now, there's a number of things that a person needs to understand when it comes to doing a mortgage with registered funds. A lot of the rules are made by the Canada Revenue Agency, the CRA, but all of the registered funds have to be held by a trustee authorized by the CRA to be a trustee. Banks are trustees. There's a number of finance companies that are trustees, but not all of them will allow a person to invest in a mortgage. If you walk down to the Royal Bank of Canada or the Toronto Dominion Bank and say, hey, I've got RRSPs with you guys, I want to put on a mortgage, they'll look at you as if you've grown a second head. Because they're not in that business. They don't understand that business. They'll actually try to talk you out of it and make sure that you buy one of their
Mutual
funds.
But
so the big thing is that there are some rules that the trustees apply. For example, we have yet to find a trustee that does mortgages with registered education savings plans, the RESPs. We haven't looked hard because we really haven't had anybody that really wanted to do one. But a few years back, there was somebody that was thinking of doing one with some of their RRSPs and
disability.
Sorry. Yeah, it was the disability.
Sorry about that. Yeah, it's the registered disability plan,
plan.
not the RESPs, the education one.
Yeah.
Because we've been able to use those. Yeah, it's the disability one is a problem. No one will do those.
I don't do those, but I mean, I think fortunately, if there's one where they won't do it, I'm guessing that there are way fewer. The amount of money in the disability fund side of things is a lot smaller than in the RRSP or TFSA or RIF side of things. So that probably balances that out.
Well, let's say we had someone that had $140,000 actually in a at the time was SDRSP, I think it was called, the disability one. And we went through the whole process of moving the funds over with a trustee that would allow it.
Oh.
And it took 8 months. And at the 8-month mark, when it was ready to sign the paperwork, the trustee came back and said, excuse me, we've just made a ruling that we're no longer going to do this after 8 months of working on that file. And the lender had no option but to go back into mutual funds or some other vehicle that she could try to put it in there.
Now,
As we're speaking about trustees, I think it's important for people to know that, RBC and TD and other big banks that are also trustees aren't interested in this part of the market. And in fact, it seems to us that most trustees are not really too interested in, and that there is one trust company that really does the lion's share of this. Am I understanding that right?
Absolutely.
That's what we've seen. Yep.
Yeah. Olympia Trust is probably the largest trustee that real estate investors deal with, because the rules have been a lot easier to deal with. Canadian Western Trust still does as well. B2B stopped doing them. There was another one, Community stopped doing them. There was some of the trustees. There were 5 trustees before, and now we're down to 2.
Yeah.
And
so that's important for people to hear. So Olympia Trust, I think their head office is in Calgary, but they are a trustee for funds across the country. So you're in Ottawa, I'm in Edmonton. Both of us can deal with Olympia, correct?
That's correct.
Exactly, yes.
And as a matter of fact, a few years ago, they finally opened up into Quebec as well.
Oh, did they?
Because they hadn't been willing to fund mortgages for properties located in Quebec. And Denise and I actually worked the first mortgage.
The very first mortgage in Canada to do it in Quebec.
One of our colleagues here in Ottawa owned property across the river in Gatineau, Quebec.
Right.
And they wanted to put a second mortgage on that property, and we helped them do it.
Yeah.
Good. Well, that's you're being trailblazers here all the way. I guess we can say that. So, folks, if you're listening, Olympia Trust really is the trustee across the country. Canadian Western Trust does some of this, but they're not near as big a player as Olympia. So, you don't even have to really think about it. Just if you're investigate with Olympia, I think is a good way to get started.
And they've got a good support, like a customer support as well. We've been dealing with them since 2013, only because although we've been doing mortgages since 2010, we used to be with TD Waterhouse, and in 2013, they stopped doing them. Right. So we had to find another trustee, and Olympia Trust is where we continue to work with, and it's been great. Like I said, they've been awesome with us. Customer service is great. Some people have issues, but then everybody does. You just work out through the issue, and that's it.
I do notice over the last few years that Olympia has really ramped up their game. I think they've committed more to this market, and it's not just an offshoot. They've figured out how to do it so they can do a good job, make some money for them, and help people. So I think Olympia is doing a pretty good job. They've got better ways of connecting. They're easier to talk to. They've got a lot of streamlining done. So Olympia are the trustee. So but let's move on to helping folks listening who have never done this before. And let's start with somebody who who has an RRSP or a registered plan. They have a registered plan. They've got some money in the plan, or no, worse yet, they have mutual funds in their plan right now, but they want to be a lender. So what would someone just getting started in that circumstance, what would they do?
Do you know how many calls we get like that, Barry, saying, Denise, we got your name. Can you help us? We don't know what to do.
I'm pretty sure we get a lot of calls.
Yeah, we do. And the thing is people have to understand what it is that they want to put their money in. First of all, just because they know they can do mortgages, is that really what they want to do, right? Are they? So first of all, you got to talk about what their investment plans are and whatnot. But when it comes time to doing mortgages, they do have to make sure. And this is where we tell them, and we spell it out, because there's a key word in here that you have to really be careful of. Is when we tell people is you go to your financial institution and you must sell off all of those mutual funds or stocks and make sure that it stays within the registered plan umbrella. Right. That means when it gets converted to cash, you're not taking the cash. You never, ever, ever touch the money from your registered plan. Ever, until you decide to take it out later. This is not taking it out. It's moving it from one financial institution to another. That's all that's happening.
Why is that so important, Denise? Why is it so important not to have it out of the plan, but to transfer it from plan to plan without it ever coming out of a plan? Why is that important?
It will trigger tax consequences. So CRA will say, You've taken that money out, and now you've got to pay all the taxes on it.
And the most important thing to keep in mind is that if you're taking it out of an RRSP, thinking that you'll walk down the street with cash and put it into the Olympia Trust account, you're not allowed to regain your contribution room within an RRSP. So if you had contributed the maximum amount into your RRSP and then you do a withdrawal, you can't put that money back in.
And plus you've paid all the taxes on it. And then you're maybe using a big whack of it rather than what you wanted to do later on in life is take out a little bit at a time, when you were less income. But
we always train people to say that they want to convert their holdings to cash within their RRSP.
Right.
Yeah, under the RRSP umbrella. So once they've done that, and that can take days or weeks. It all depends on who you're with in terms of financial institution. We always tell people when you decide to do this, and Olympia Trust will actually even say that too, it'll take 10 days to 6 weeks.
Yeah.
So
right.
don't think you can do it overnight. So that's got to be changed into cash, period, into the umbrella, the registered plan umbrella.
Timely. So that, folks, you need to write this. You need to write this down. If you're thinking of doing this and you have an RSP that's got mutual funds or stocks or some other sort of investment in there, you are converting to cash within the plan. Converting to cash within the plan. Those are your words, right?
That's correct.
Yes.
Convert to cash within the plan.
Yeah.
So important.
Yeah.
And now when somebody goes off to their big bank where they have their RSPs and says that's what they want to do, what are they likely to hear from whoever is helping them at the bank or helping them?
Oh, are you crazy? Don't you know that real estate is in a big bubble? You could lose everything.
Yes.
Which is code for, oh, please don't take away the RSPs. I'll lose my fees.
Yeah. Okay. So folks, be ready, for the lender to gently or maybe not so gently persuade you that converting your holdings to cash within the plan are not a good idea. So that's just a little coaching on the side. All right. So that's a step. You got to have some cash in the plan, because once you've converted the cash within the plan, what is your next step?
So once it's in cash in the registered plan, then it's a matter of filling out the paperwork. And now it's done online with Olympia Trust. And you fill out all the details and they will take care of moving the money. You don't do that. So Olympia Trust will go to your current financial institution. So you need to give them all the details, where it is, your account number, all that stuff of the plan that you're currently in. And Olympia Trust will make that transfer. That means opening up an account. But they always tell you, don't open the account unless you've got money to put in it yet, because there's a fee to opening up an account at Olympia Trust. So it's better to wait to open it when you're ready to do the transfer.
Yeah.
Not because you just want to do a mortgage. That's not when you open up an account.
No. Well, that's good coaching on their part. And I think that's part of what Olympia is doing better from their perspective, and why they're, I think, a little more enthusiastic about registered plan lending, is because they've realized that it's fair to monetize the work that they have to do, and they are getting paid fairly. So you have to set up a new registered plan with Olympia, but having said to them that you want to do that, they will walk you through that process. They'll tell you about the timing, and they will organize getting your money from wherever it was into the new plan at Olympia without it ever having left a plan, and therefore there's no tax being triggered. And the end result is you have a new registered plan open at Olympia with cash in it.
Yeah. And the other thing is too, is if you have different types of registered funds, like somebody may have a TFSA, somebody may have an RRSP, then that means opening up two accounts. You can't combine them in one account. So it's two accounts, so a separate account per type of registered funds that you have.
Okay. All right. So for someone who wants to become a registered plan lender, that's how you actually get some money into a plan from which you can lend. That's great. Now we've got the pot of money, and we are someone who did this so that we could be a lender. What is this person's next step? Well, I guess we're going to assume that they have a line on a borrower. Someone has come to them to say, I would like to borrow some money from you. And they went, how convenient. I happen to have money in a plan from which I can lend. But they're real newbies. They're real rookies. What do we say to someone who has the plan set up, has someone they think they might to lend to, but they're really not very knowledgeable about the lending side of things?
One of the things that I just kind of maybe want to mention first in terms of these people, when they contact me, let's say, and this is what they want to do, one of the key questions I ask as well is how much money they want to move over. Because if they have $5,000-$10,000, it is not worth moving it over there because nobody's going to be able to borrow that money. Yeah. So that's a key important thing too. So just because you have a few $1,000s doesn't mean that now you should move it over to Olympia Trust and be able to loan it out.
Target number?
Target number, I mean, back in 2010, until we have the limitations that we have now because of new rules that came out last year with Olympia Trust, we were one of the few people that would use smaller amounts because we could put several people on the mortgage very easily. Now there are rules around that. So there's kind of a cap of the amount of people that you can put on a mortgage and still make it, what's the word I'm looking for? Less costly for you to do a mortgage. Otherwise it becomes exorbitant and you may not be able to do that mortgage. So we would do this, but why we would take somebody maybe with 30K, 28K or something like that. You realize that those investors now, because they've been investing with us for 13 years, just how much more that amount is now. And they kind of thank us because they've been able to grow, you know, because nobody would touch them before. Nobody would borrow their funds because it wasn't enough. And we know a lot of people that won't touch people unless it's at least 100K or more.
Yeah.
We've always tried to use lesser amount because we've always wanted to help investors. Yeah. And that was one of the ways to be able to do that, or help the mom and pop. We just don't deal just with other real estate investors, but with mom and pop, let's say, that want to loan their money because it's a way of them getting better interest than what they're getting now. And sometimes they don't have a huge amount. So today, in terms of amounts, if you're looking at one of the rules that Olympia Trust came out with, is you can use the services of a mortgage broker, or you must use the services of a mortgage broker if you have between 2 and 5 people. Because after 5, so from 6 plus, you must use a mortgage administrator. And this is where the fees start adding up a lot. And they're hard to find somebody who will be able to do those mortgages. So you try to keep it between 2 and 5 people, so that if you're getting a mortgage, let's say $500,000 mortgage or a $300,000 mortgage, no matter what, 5 people, well, you can't put 5 25Ks in there and expect to do your mortgage, right? Because it's going to be costly to be able to do that. Yeah. So from that point of view, you have to look at what it is that you need when you do a mortgage, but to see what the other investor or the other real estate investor who needs the funds, what they are looking for, whether it fits into that category. And people should know this before they even start their first mortgage. They should have a plan that the reason why they're doing this is because they have a place that they're going to put it in and they fall within, call it the rules or the parameters of what they want to do.
So folks, for you folks listening, one of the things about the registered plan side of things is that the rules have been subject to a lot of change over the years. Now, Stuart and Denise, this last set of rule changes from Olympia was a pretty big set of rules, but I have noticed over the years that there have been numerous policy and strategic and internal rules about what you can do and what you can't do. So it's really a fluid situation. And when I'm, as a lawyer, as a real estate lawyer, when I'm being asked to look at a registered plan mortgage, depending on which side I'm on, I always try and check and see whether the rules that applied the last time I did one are still applying, because I've been surprised enough times on changes. So the lending landscape has changed. So let's talk about this really big change that occurred, I guess it was last year, where instead of having no requirement for a mortgage broker or a mortgage administrator, when you were having more than one person on a loan, those rules change. So if you're having 2 to 5 people lend, you need a mortgage broker involved.
That's cool.
And how does Olympia tell you to get a mortgage broker involved? They have a roster of brokers they can point you to, or they just say you have to find one? And let's answer that first, and then tell us, what does the mortgage broker do for the group of 2 to 5 people?
I think the one thing to keep in mind is that the rule was put in order to help Olympia Trust manage their liability issues. Mm-hmm. There had been a number of things that had happened in recent years that Olympia felt very exposed. So they brought in the new rule obliging the use of a mortgage broker or a mortgage administrator, because those are 2 industries that are quite well regulated. And a mortgage broker has to go through certain risk tolerances and certain background checks to make sure that the person lending the money understands what's going on and qualifies as a lender. And when I say qualifies as a lender, the one thing that a borrower needs to keep in mind, and a lender should keep in mind, is the fact that there are Security Commission rules about who can lend money and who can borrow money. Specifically in the lending, if a person is a high income, a high net worth individual, then the Security Commission believes that they have enough understanding to be able to manage their money. But if a person is an ordinary mom and pop, they're not earning over $300,000 a year as a couple. They're not earning, they don't have financial assets of over $1 million, not counting their family home. If they're just an ordinary person, then the Securities Commission expects them to only lend to people who are either close friends, family members, or close business associates. Because the idea is that those people, you are expected to have an understanding of the way they manage money to know that it's a safe risk for you to lend money to them. So as a borrower, when you're taking a look, I mean, Denise and I will mention, she mentioned that, lots of times we get people that approach us out of the blue saying, hey, I've got RRSP money. Do you want to borrow it? Well, we say, we'd love to borrow it, but we're not going to touch your money until we've developed a relationship. We need to get to know you first. We need you to either be a friend, a family member, or a close business associate. So let's start building a relationship. So someone who wants to get into the private lending, while they're doing all the work to move their money to Olympia Trust, get into the real estate community and get to know people. Start to meet other real estate investors so that they will have a sense as to who is a safe risk to be with. And that will help them move forward to decide whether they should be lending money to someone or not.
But under the broker's rules too, I mean, they have certain criteria that they have to meet to make sure that everything is above board and that they fall within a regular exemption to be able to be a lender. So they have safeguards in place and certain documents they need to fill out and everything, and to be able to satisfy, Security Commission's rules and things like that. So it has to be, they have to meet certain criteria before they say, okay, yeah, we're going to put our name behind this mortgage and allow it to go through, type of thing.
So is that something that is the mortgage broker going to have that conversation with somebody who wants to be a lender to see who they are and what they have for qualifications, kind of supervise that aspect?
They're actually obliged to do it. They have what they call a KYC, know your client. Mm-hmm. And they actually will go through that in order to identify what the lender's sophistication is.
Okay, so this is Olympia having maybe been exposed to people saying, you didn't tell me about all the risks and I lost all my money, and Olympia's going, hey, we didn't do any of that kind of stuff. But nevertheless, when people accuse, you have to defend. Yeah. And so this is Olympia going, you know what, folks lending and borrowing need a bit more coaching from experts. We're not lending experts, we're trustees. Which is a different thing. So that's kind of why they did that. So I want to talk more about this aspect. We got a question here from Martina. Can you guys see that question?
We do see the question, and
Okay.
it's a
Over
great
to you.
question. Canada Revenue Agency has what they call arm's length dealings. And it doesn't just apply to RRSP lending, it applies to a number of other things. So if you're a nerd like me, you can go onto the CRA website, search on arm's length, and read the whole big long document on what an arm's length transaction is and what it isn't. And when Denise and I did our course, I in order to keep it straight in my mind, did up a little chart that shows people and their relationships.
Good one.
With the dark little icons here, people you cannot lend to because you are not at arm's length. So
arm's length and non-arm's length,
yeah,
right? So there's the two.
You are
sides.
not at arm's length to yourself. You are not at arm's length to your spouse. You are not at arm's length to your parents, your children, or your grandchildren. You are not at arm's length to your spouse's sibling or your sibling's spouse. But
or if you're part of a corporation, it's your corporation, then you're not at arm's length.
Yeah. So if you own more than 10% of the borrowing corporation, you're not at arm's length with the corporation. Now, who you can lend to in your family? Your spouse's sibling's spouse. So your brother-in-law's wife.
But aunts, uncles. No, it's aunts, uncles, nephews, nieces.
Your brother-in-law's wife is arm's length. Your aunt and uncle are arm's length.
So it still falls under family because you're related, but you're not close family.
Your niece, your nephew, they're considered arm's length according to the CRA. So there are family members. It's important to check this out based on your specific circumstances, who the person is that you're talking to about it. But there are people that you show up at Thanksgiving dinner with that are considered to be arm's length that you could do a deal. Now, I think this has probably been covered before in some of your private lending situations, but doing transactions with family is full of risks. Always remember that if something goes bad in the deal, you still have to show up at the Christmas family gathering and see these people. So I don't necessarily recommend loaning to family, but it's important to know that that is a possibility depending on exactly where they fit into the circumstances.
Yeah.
That's why we like close friends and business associates better, because with them, especially people that are involved in real estate, they understand the risks. They understand what goes on. And one of the things that Denise talks about is the importance of maintaining open communications with our lenders so that we're always talking with these people. We're maintaining good relationships with them.
And that's the key word, relationships. You have to develop relationships with people because that's what is going to allow you to have that growth that you want. I mean, you can go private, you can go through a mortgage broker and saying, hey, I want this mortgage, and they are going to provide maybe lenders for you and, fill their rules and parameters that they need to fill out. But the way we've always worked it is we have found our own lenders right from the get-go. So there are people that have, when we do mortgages, there are people that are now like in their 5th, 6th mortgage with us. Like people, after they've lent their money and they get paid out, they say, is there another one I can put it on? That's the first thing they ask. And that's what happens when you develop those relationships, is you get that group of investors that they've gotten to know you, like you, and trust you, and they just want to do more.
Yes.
But it doesn't happen overnight. And that's what people have to remember too. It doesn't happen overnight.
That's a key point to successful real estate investing, that the building the relationship, the trust that comes from it, and the ease and the ability that building trust in the relationship gives you to carry on. I mean, it runs through joint ventures, it runs through lending. As long as you are upfront, do what you say you're going to do, maintain the relationship, have good communication, and then when a loan or a joint venture mature, and you say, okay, folks, well, as we promised, here's all your money back. And they go, no, we don't want it back. You just really have to do one successful one and have people feel like they're being communicated with and treated fairly and honestly to have that happen, just like you said, Denise. Is that not true?
Oh, absolutely. Yeah. I mean, that is probably the very biggest important factor when you're dealing with mortgages, and the people you deal with is creating that relationships and building that know, like, and trust factor. Yeah. If you don't have that, people should not be investing with you, and you should not be investing with anyone if you don't have that know, like, and trust factor. It boggles my mind that people will say, oh, I just lent money to somebody. And I go, oh, on what? And they go, well, I'm not sure. And I'm going, well, didn't you get any documentation or what? Well, yeah, there was some paperwork. I just signed it. And I'm going, oh my gosh, how can people loan money and not understand what they're loaning on? Which is part of the reason that we never loan to a brand new investor. You know how they say your very first property you will ever have is the one you're going to learn the most on. That's where you're going to learn from all your mistakes.
Yes.
Well, I'm sorry, I don't want to use my money for your learning experience and all your mistakes and possibly not get my money back.
Okay, so there is a really good piece of coaching diligence for people who are thinking about lending, because as a lender, you have to, as the mortgage brokers and bankers like to say, you have to underwrite the loan. Underwrite the loan. That's the process of investigating the loan and looking at the 3 C's of the 4 C's of the 5 C's. I'm never quite sure how many C's: credit, capacity, character. I'm never quite sure how many of those C factors that the brokers are looking at. But from your perspective, they've got to at least have owned one property and they're working on their second before you would lend. Is that right?
We personally, and that's us, we personally invest our funds with real estate investors that have a track record. Mm-hmm. And if they don't have a large track record, they're usually being mentored by somebody that we are well aware of their coaching abilities and the success they've had with their students.
Yeah.
And that's just us personally, but that's how we invest.
Yeah. Well, I think that's really great coaching. And when you're starting out as a lender and you don't really understand the underwriting process, because it's like everything else, these strategies and sub facets of the strategy can be quite complicated. And I mean, all of us did different things in our other careers and jobs, and it takes time to get good at anything. And it takes time to get good at lending. So one really good coaching bit is not to lend the first time. And I would even extend that. If you're really a cautious, conservative person, I would like to see you lend to somebody who's done 2 projects
or
before,
more,
and you help out on their third one. That would be an extra layer of protection for you.
And I mean, that's a really important point, is what is your risk tolerance?
Yes.
What are you willing to accept as a lender as risk?
Yeah. Yes. And that's a hard one. That's a hard one to figure out. That's a hard one to figure out. And sometimes what I say to people is, all right, so you're getting an interest rate of 15% on this loan, and now it's gone bad, and that your loan to value is up there high enough so that it looks like, the first mortgage lender will get paid out, and you're a second mortgage lender. And so, how do you feel now about this loan? And lots of times people say, I should have kept it in GICs. And so they didn't really have any risk tolerance, but they didn't ask themselves the question, if you lose all this money, how are you going to feel about it? Firstly, can your finances stand that? And secondly, is it going to drive you to drink, or worse, if you lose all the money? I mean, should you just be someone who invests in GIC? So you're assessing your own risk tolerance. Absolutely. Is a process that people have to go through, for sure.
And it's not necessarily an on or off switch for real estate investing, because if someone is approaching you and offering 15%, you need to assess why they're willing to pay that much interest when other people are only offering 8%.
Yes.
And usually there is a difference in the loan to value. There's a difference in the way the project works. There's a difference in
Risk.
I mean, one of the things that Denise and I made a decision on very early is we don't like investing in rural properties.
Right.
Because if we had to take possession of the property and sell it, it takes a lot longer to sell a rural property than it does an urban property. So again, it's coming down to risk tolerance, and there are ways to get involved in lending your money on safer projects. And part of that is very experienced investors who are going to be borrowing your money, and they've got a solid plan. I saw something that George put up earlier. The deal has to make sense.
Could we just do a little segue? I want to go back to the trustee, and what does the trustee actually do for you? So I'm going to just ask you the question. So we're talking about Olympia Trust as the major trustee in this sphere. What does Olympia Trust do for the registered plan holder who wants to lend money? What do they do?
When you think about the trustee, like Olympia Trust, think of it, I guess the way I make it super simple, and when I explain I explain why they need to go over there, because they allow to be able to do mortgages, is I said, just think of it as just another bank for you. Yes, there are certain things they have to meet in terms of CRA rules and everything. However, think of it as a bank for your registered fund. But the trustee is trust. So they are acting on your behalf to loan that out because, well, first of all, and I know Stuart sometimes mentions that the government doesn't trust you to look after your own money. So you have to have somebody else, look after your money.
I did 30 years with the federal government. And in the various jobs that I had, I spent 5 years of that with the income tax department. And what I learned is inside the sausage factory, when it deals with money that taxes have not been paid on. So we're talking about RRSPs, when we're talking TFSAs, when we're talking about the HST that is owed by a company, when we're talking about employee deductions, the people at CRA think that's their money. And if you're doing something with it, they don't like that. As such, there's lots of rules that they have around what they call these trust funds, including registered funds. The trustee has to follow all of the rules that CRA sets in order to have your money in a place where you can use it with some of these strategies. So even though you're thinking, well, I'm paying all these fees to a trustee. Well, if you don't put the money into a trustee, you can't use it in a registered mortgage. And you're not going to be getting the returns that we see on registered mortgages. So the trustee is your friend from that regard. But like a close friend or a family member that's a little bit older, sometimes they're going to put their hand on your shoulder and say, you can't do that, because they have rules that have to be followed.
Yeah. I never thought of it that way, that the CRA makes it so complicated when there are trust monies, as you described them. They make it so complicated that even if you could do it on your own, it would be working your way through the thicket of rules would make it practically impossible for any normal human being to actually get to the end where the CRA would say, okay, well, yeah, okay, you can lend now. So, that's why that's a really great reason, an explanation for the existence of a trustee, and particularly Olympia. So tell me this now. So you've done all your diligence and you've gone through it all, and the loan is set up and it's been funded. And as the plan holder and the mortgage lender, you've now received 2 payments from your borrower, and then they stop paying. What does the trustee do there? Because the payments come to them. What do they do if the borrower stops paying?
They send you a very nice letter saying, your borrower stopped paying, you better do something to collect the money.
Because they won't. The trustee won't.
Okay,
when I say important. They hold your registered funds, that's what they do. They do not take any enforcement action at all.
Right.
So at that point, the best way is actually to talk to your borrower
Of
and
course.
be able to, sort that out with them. And who knows what the circumstances may be, but if it's at a point where the money just is not coming, there's no communication or anything, you have to take action. You must go to a lawyer that does do enforcement action on mortgages.
Right. So,
So
folks, that's important to hear. The trustee will not try and collect those errant monthly payments for you. And if the payments don't ever start coming in again, you will have to go hire a lawyer, and you will have to help that, or get that lawyer to help you. And it, as Denise said, it has to be a lawyer who understands the enforcement process, because it's a separate little subsection of the law. Somebody who does family law all day long, is not a foreclosure lawyer. Or somebody like me, I am a real estate lawyer. I understand this really well, but I am not a foreclosure lawyer. So you got to have a lawyer who will help you work your way through the foreclosure. So the trustee, when we're talking about what their job is, that's their job is to work with you to set up a plan that meets CRA requirements, and then to help you at least set up how you would lend, even if you have to use a broker or an administrator. But they don't do anything more than tell you that a payment's not been made, and they certainly don't foreclose for you. So limited involvement by the trustee on the enforcement side of things. That's important to know.
yeah.
Now, the other thing that comes into that, and this is why it's so important to do your underwriting before you actually make the loan, to understand who you're lending to. Because if you have an RRSP mortgage go bad, you can't write off the loss against your income tax, because it's pre-tax money. It's held within the trust fund. So there's no tax loss that you can claim there. The other thing that we have heard is that if you don't make the effort to try to collect that money, CRA may decide that that wasn't a real commercial loan, that actually that loan was against the CRA rules, and they may go back and decide to charge you income tax on all of the funds that you put into the mortgage. So not only have you lost the money that was in the mortgage, but now you have to pay tax on it. So it's really important, when you're a lender, to understand who you're lending to and do your due diligence to make sure that you understand the deal that the money's going into, and that it makes sense, and that chances are you're going to be getting paid back. At the very least, you're going to get your principal back.
And one of the key things that Stuart just says, the deal has to make sense. And I guess we didn't quite mention that, but one of the things, you should never lend until you have a full investor package describing where that money is going to be used, how it's going to be used, where it's going to be used, when is it going to get paid back. There's so many things that need to go in there before you actually say and sign on the dotted line saying, yes, I'm going to do this mortgage.
So that's coming at it from the borrower side of things. If you're looking to borrow, then you are looking to describe what you need, describe who you are, make sure there's lots of data. You're trying to give your lender comfort that you are a good risk, and no point going out looking for money if you're not ready to give the lender the kind of information that any smart lender will ask for. I know people will just lend with nothing, but you're trying to keep this professional and above board and informative, and give yourself the best chance as a borrower of having a lender say yes.
Yeah. So that lender should never lend unless he's got a full package describing everything about that particular project that he wants to lend money on.
All right. So that's an underwriting thing, isn't it?
It is.
As a lender, you want all the details of the situation and the loan.
Yeah.
Now, the one thing is that it needs to be reasonable, because you're not the Royal Bank of Canada or the Toronto Dominion. So you don't necessarily need all of that information that the bank is going to ask. If you're going to put yourself into the position of exactly doing the same thing that a bank does, then expect that your borrower is going to go to the bank, because the whole idea of a private mortgage is that they're more flexible than what a bank
Yes.
can offer. But at the same time, there are a number of things. I mean, Martina there says, what are some of the basic due diligence steps? Well, I mean, we want to understand the project. And one of the questions that we always ask ourselves is, would I buy this property and do this deal myself? Because if I have to foreclose on this, I may be doing the deal myself.
Right. Okay. So let's try and talk about, a few more of the basic diligence steps that you would do as a lender. So we've talked about you're looking for as complete a package as you can get from a borrower on the particular project. Tell us about how you adjust for the Olympia rule that they will allow up to 100% loan to value ratio on all of the loans that are on a project. How do you deal with that?
For people who have never loaned money before on a mortgage or loan registered funds, always be careful about loaning maybe 100% on there, because you need to have a certain risk level that you understand yourself that you have and be able to loan that money out. Now, the banks do 80% loan to value. A lot of private investors will borrow up to 100 because they're not like the banks. I mean, that is one way. Now, that 100% may make sense as well. We've done many at 100%. But the only way we would do 100% loan to value on a mortgage is because there's going to be an uptick basically on the value of that property. You're doing something to be able to raise the value so that when the value is raised, then you actually refinance and you pay everything back. You would never do 100% loan to value. And we've had people come to us to say, oh, I'm looking for this much. I want to buy this property. It's a duplex and we want to rent it out. I said, are you doing any renovations on it? She says, no, it's good as is. I'm not going to invest at 100% loan to value on a property that is not going to increase in value in how long? And because the interest rate is higher usually than a bank, this is not something you do long-term, like a 20-year AM or 15 years on a mortgage. They're usually shorter term.
Yeah.
So you have to understand here that this money, what's going to happen in that time frame that's going to be on there? Will there be an increase in value? Because that is a way to basically show that you can get paid back.
So so just to divide those two things up. So almost always, we're never going to lend registered plan money on a basic real estate investment where somebody's buying a property. Their plan is just to take it, buy it, put it in their long-term buy and hold portfolio. And really all they're looking for is to borrow as much money as they can. So folks, so you understand this, if you go into any of the big banks, they're only allowed to lend up to 80% of the value of the property. If they lend more than that, the loan has to be insured under the National Housing Act, which people commonly refer to as Canada Mortgage and Housing, or CMHC, in which case you can get up to 95% if you're living in the property, and I think 85% if you're an investor. So the question you have to ask yourself is, if the banks aren't allowed to and don't want to lend more than 80% unless they are insured, why would you be doing that? So we're dividing it up kind of into the buy and hold portfolio where nothing's being added. And then I guess on the other side, we're really talking more about a fix and flip where somebody buys an undervalued property. They're going to add a bunch of value by doing a renovation. And when they're done, the after repaired value is going to be much higher than it is now. And is that where you find your protection there, is in the increase, the lift?
In the increase, yeah. I mean, you mentioned fix and flip, but there's also the BRRRR strategy, the buy, renovate, rent, and refinance. Because one of the things is that if you're going to one of the major lenders, they hate to do a refinance within a year. Mm-hmm. So if you're buying a property that you're going to be spending a few months renovating and then hoping to refinance, private money is probably one of the better strategies to use.
Yeah.
And that's why, depending on exactly what the renovations are going to do and what the expected value is after the renovations, it might make sense to allow a 90-95% perhaps even 100% loan to value on the private mortgage, knowing that the investor, the buyer, is using their own money in order to do the renovations, going to have them done within 3 to 6 months, and then be going for a regular finance. So they know their exit strategy. And when you, as the lender, take a look at their prospectus, what we call the investor package, this is all clearly laid out, and it shows that this person has a plan and they know how they can actually take this property and increase the value and then qualify for a refinance at the end.
Yeah. Big diligence there, folks, on the experience side of somebody who's going to employ the BRRRR strategy or fix and flip. All right, we've got time for 2 questions. George had one, Donna had one. So Donna,
Mine's up first.
Donna's up first. Yes, dear. We're doing yours first. Producer's rights, right? I mean, she's controlling the button. So
Love it, Donna.
I think what Donna means is there any insurance such as National Housing Act, CMHC insurance for us as a lender, or are we doing without that kind of insurance?
Well, being a mortgage, it's actually some sort of security right there, as opposed to if it was an unsecured loan, like just a promissory note or something like that. So any type of mortgage is definitely sort of up there in terms of being able to get that money back. And as we know, there's been a lot of issues in this past year with a lot of people basically not fulfilling the obligations and losing out, foreclosure or not. I mean, They eventually went bankrupt, but the idea is they could not pay back a lot of mortgages. Yeah. And some of them who had mortgages were able to get some money back. People with promissory notes did not get any money back. Yeah, so
the power of your security that you take.
Exactly. And the other thing that we offer as part of our mortgages is we offer a personal guarantee as well. Although we buy everything in a corporation, we offer a personal guarantee. And the thing is we'd be prepared ourselves to go get a mortgage on one of our other properties to be able to pay somebody out if we had to. Because again, it's something important to think about, that you are borrowing somebody else's money. It could be their livelihood. It can be their future retirement. It can be, the obligation is on you when you as a borrower to make sure you make that lender good.
Yeah. I mean, folks, that is, as Denise was saying that, I'm thinking that as a lender, if you ask someone for a personal guarantee, they want to borrow in a corporation. So it's their corporation making the loan or borrowing the money. But if you want a personal guarantee from them and they go, oh, no, I don't give out personal guarantees. Maybe you've got to look at whether dig deeper into that loan, because Stuart and Denise say we always offer a personal guarantee because they plan to pay back. And if this property did not work out right, they would do something else and pay back. So that's an important diligence question. Then you have to assess what the answer means. All right, we've got time for one more question.
It wasn't. It was just a comment.
It was a comment.
So
all right. Stuart and Denise, where does 1 hour go? I want to ask you. My goodness.
It's something we could talk about for hours. And I know when you and I talk too, it's just like we could go on and on and on. There's always something to talk about. Yes.
Got to feel bad for Stuart and Denise. Can't get a word in edgewise here. My goodness. All right. Well, listen, thanks again for coming on. We may do another extension of this because there's so many nuances to private lending. As we went through the stuff today, I'm going, what about this? What about that? What about, you can have the surface look, and then you can dig into the other layers of a whole bunch of different aspects of private lending. So thanks again. We really appreciate it, you guys coming on, and we're going to do it again soon.
Great.
Always a pleasure.
Yeah, thank you so much for having us on.
All right.
So thank you, Barry, and Donna, who's in the background there.
Donna's in the background. All right. Well, thanks again, and we'll just sign off and say good night, everybody.